we are not an island. We are living in a reality where what happens externally affects us. 2020 was the year when the black swan of COVID-19 hit the markets, and investors were really moving their investments to cash and near cash securities, investments towards the domestic markets, and risk hedge commodities like gold recording, I think it was in August 2020 when gold recorded an all-time high.
Do you feel there's still some potential? You did say that the tide changed.
The so-called easy returns were now dying off.
Perhaps you might drop that word, the big B word, the bull. Hi, and welcome to another episode of Make Money, the podcast. Now today, we look back at the stock market performance from 2024 as we look ahead to the earnings season. And I think the context here is that last year presented, an anomaly, but being a positive surprise after quite some years of a bear run where we saw price erosions and market cap declines. Basically losses for investors. We saw the tide turn and we ended with the market up about 34%, a rarity from the previous years. And as we look forward to 2025, I think earnings seasons are set to be quite definitive to the performance of the stock market in 2025. And I'm happy to continue this discussion with a guest. He's a regular guest on this podcast. I think it's a hattrick of appearances now, Mr. Wesley.
Thank you for having me.
Yeah, welcome to the podcast. So you're a senior research associate at Standard Investment Bank.
Yeah.
And happy to be here. And the good thing, we've maintained the same topic with you this at that time, but we are having it different in that we are coming back over quite an impressive year, from the norm of what we are used to the last 10 years. And I think just to quote some of those numbers, we saw if we just use the overall index up 34%. So on average, equities were even beating the fancy government papers that we've spoken about, all year long, your money market funds. None could actually touch equities if you were to get the average return for with the index. And now, as I think the best point, looking forward again, we know the earnings are quite expected to be healthy. We've seen already what KenGen and the likes of Kenya Power have been doing in the market. We know banks are set for a strong performance reporting based on the disclosures we might have seen. I think some of the numbers we see from the central bank, pre-tax at a record for the year 2024. So we do know that there's quite some oomph in the market, at least in the opening quarter of the year. I think to start us off, it's important to understand what was different last year? What spelled the difference? I think the last time we had this conversation, we were still arguing whether you can actually make money from the stock market. And fast forward, the year is done. We were 34% up on the year 2024. And even so far this year, we are up around 6-7%. What has made the difference? What has changed since we had these conversations last year?
Two things. First, we'll start with what has been happening locally. We saw last year easing in monetary policy stance. Again, inflation came in line. It eased down, and more than anything else, there was improvement in business outlook, looking at what the PMI was indicating. And coming now closer to the bows, key sectors did a bulk of the heavy lifting. For instance, the banking sector, out of what you've mentioned correctly, 34%, it contributed 19.7% of that. Then you have the telecommunication sector coming in at 8%. So you had these few key sectors doing the bulk of the heavy lifting. For the banking sector, it was clear. Record earnings. Record earning means dividend outlook is good. Yeah. So investors were discounting this information into the price level in anticipation of the 2024 financials and dividend play. In the telecommunication sector, discount, it was trading at record discount, and you've mentioned correctly, there was a tip in the wheel, part of it local, part of it global. When you look at the local macroeconomical environment, what we've mentioned was key in the play. But then we are not an island. We are living in a reality where what happens externally affects us. And for an investor or someone in the audience who might not be aware, when you look at 5 years back, let's take a journey to 2020. 2020 was the year when the black swan of COVID-19 hit the markets, and investors were really moving their investments to cash and near cash securities, investments towards the domestic markets, and risk hedge commodities like gold recording, I think it was in August 2020 when gold recorded an all-time high. Then came 2021. Markets were really recovering towards this new normal. Again, there was that good news of vaccines coming in, and again, the global economy was reopening. But then there was an issue. The demand was higher than how the supply was coming in from the reopening.
Yeah.
So there was a little bit of inflation kicking in. And 2022, while that was still a reality, up came the Russia-Ukraine crisis, threw everything off the wind. And markets being sensitive to risk, investors remained risk off.
Yeah.
Then again, 2023, still the same case. But then something different in 2023 was the fact that investors were now anticipating elections towards 2024, with about half of the global population going towards the election in 2024. That meant policy shifts and the global divide becoming wider and wider. Investors started moving investments closer to their home markets and secure investments. But in 2024, we had easing monetary policies globally, and that meant that the so-called easy returns were now dying off. Now you had to chase that strong alpha. From the developed markets, we saw investors looking more and more into emerging markets. India was a key play on that perspective. But then, movements come from the developed markets to emerging markets, then to the frontier markets.
Yeah.
So when you look at that perspective, you'd find even local investors wanted to get that fast move advantage, where you get in to lock these investments at a fairly low price.
Yeah.
And that was quite key for investors who are sensitive to what's happening externally, because at one point in time, they expect the tide that went out in terms of foreign flows to come back in.
Yeah.
So those two factors had a key play in what we saw in 2024.
Yeah. I think the beauty or the ugly side of looking back is always like you only realize how much you gained once you look back. There's nothing you can do about 2024, and that 4% up. And I'm looking at, I actually have a chart here around some of the top gainers. Portland Cement was up around 200 plus percent. It basically moved to nearly 3 times its start for 2024. So hindsight is is always good, but sometimes you can't do anything about hindsight. So 34% up last year. So the best way now is to look forward, and I would start looking forward into 2025 and what 2025 might bring with the earnings seasons. Do you feel there's still some potential? You did say the tide changed. A lot of people saw opportunity and locked in that opportunity, and then enjoying the gains, whether they are still in or they cashed out. That's done and dusted. Moving forward, is there still opportunity from, what would be earnings season? Is there still, perhaps the way to put it would be, is there a second wind to the recovery we saw last year in 2025? Do you expect perhaps the earnings as they come through? I know from next month we do see, from March, we do see banks, the banking sector announcing those dividends. Some are expected to even be at record highs. Will this galvanize what we saw last year in that it becomes a continuation, so that perhaps you might drop that word, the big B word, the bull. Maybe we might be getting the bull market now. What do you see for 2025 in taking that together with what happened last year?
We did an outlook back in our investment shop, and it had a very interesting title. It's the year to ride the bull and chart the bonanza. And in short, this means we've seen a lot of lag. Looking into 2022, 2023, the market eroded value significantly. But then this was detached from what was happening fundamentally. In as much as there was recovery in 2024, we still see a lot of room for recovery towards that fundamental break-even point where price and value are quite aligned. So that misalignment of price and value leaves a lot of room. Looking into earnings, what you've mentioned, 2024 earnings for banks will be printed in end of the first quarter of 2025. So there is room, because investors will still be pricing in happenings with dividend. But then it's an interesting play, because going forward, banks are coming from a higher base. So likely maintaining 2024 level results in the current environment where interest rates are going lower might be a challenge for them. So we might see some discounting happening maybe towards the tail end of the year when you get Q2 numbers, Q3 numbers, and even for banks that have expanded beyond the geography of Kenya, what's happening in those markets might affect pricing now once we get to that ex-dividend point where now 2024 is now fully behind us for the banking sector. For other key sectors that you've mentioned, energy being key, what we saw with Kenya Power, what we've seen with KenGen, the initial view was that this was a one-off. But then came the half-year results and there was some sort of sustainability. So you expect investors to now go back to the drawing board, and analysts go back and actually look into their models and discount earnings and these changes in terms of projections properly. And that might tailwind these other sectors positively.
Yeah. I think coming back to the title of our podcast, make money. There are usually ideally two ways around making money in the stock market. Maybe there could be multiple ways, but the main ways, you either get that capital gain when, your share price moves from 5 shillings to 10 shillings, or you also get that dividend income, whenever, you hold a stock for long and, you get to enjoy those periodic dividends. Now, looking at earnings season and the expectations for, improved dividends or enhanced dividend payout, be it the banking sector, I'm sure for the likes of KenGen and Kenya Power, we'll be looking forward to, around August, right about there. It might be far apart, but looking at the banks themselves, what's the strategy to go by earnings season? A company announces a dividend, the share price goes up, in anticipation, people want to lock in that dividend. For someone who's currently out of the market and they're wondering, I missed the 34% right from last year, I'm yet to get in, so I've already missed again the 6-7% year so far. If I'm to play my cards right now, do I go in with the dividend in mind, or do I move with, what capital gains might be? Again, noting that at the termination of, the book closure for dividends, and you get to see, you tend to see that discounting. But if you can play your card right now, which side do you go by? Do you anticipate some capital gains, or do you, move in, a healthy banking stock that you believe can pay X or Y and just, sit in there and enjoy those dividends? What's the play here in terms of making money?
The proposition is good for both investors because, number one, if you're interested in dividends, then income is coming. It will be paid. But then if you're into capital gains, once these dividends are declared, the price will move towards a point of pricing in these dividends. So you can still make some capital gains of some sort and get out of the market. So depending on your risk appetite, depending on your investment style, both investors, because this is a bull market, they say in the bull market, that's when people confuse luck for skill. Because everything is going up.
True.
And I think it's JF Kennedy who said it's a rising tide lifts all the boats. So you'd find someone will count on luck and they still succeed. Skill, they still succeed. But then years later, Warren Buffett added into it and said it's only when the tide goes down that you know who's been swimming naked. So that aspect of investment play and the proposition that you're looking into the market is very investor tailored depending on what they're looking for. But for both of them, capital gains and dividends in any sector that really proposes dividends, both of them are locked. But for heavy capital, dividend propositions are good because once you lock in these dividends in a solid company that fundamentally it's cash rich, outlook is good, strategy, the team and management is quite up to the task, then you expect growth to be baked in to the price function as time goes by. So you can lock in your dividends, still remain with the counter and unlock better pricing and dividends as time goes by. And that's the play that we've seen in frontier markets. It's only in developed markets where, because for you to really unlock sizable capital gains, there is a prerequisite where markets need to have high liquidity and more sophisticated investors who would go on the long short strategy so that at any given point in time, with any news coming into the market, the prices are volatile. So if good news comes in, you expect those who go long to push the prices up. And if not so rosy news come into the market, you expect the short runners to pull the price backwards. And so with that lack of high liquidity and sophistication in the market, frontier markets generally, a dividend play is a superior strategy in my view.
So for you, it's the dividend more so than, where
it's
the
dividend
move. I would like now to pull your crystal ball and look far deep into the end of the year. Can the stock market, can the NSE pull the same returns as last year? What do you see? How much is the upside this year? I think I mentioned there at the start. I think to the end of last week we were up about 6% year to date. Quite decent again. Just a month and a half in. But is there more? What's the upside for 2025? Baking in what you said, expected improved earnings. I mean, perhaps sometimes we might see the foreigners coming back, like you mentioned. I think we've still seen some capital flight from the local market by the offshore investors. Baking in all that, chancing in that they return, chancing in that earnings continue the same way. What's the upside you feel for 2025?
Strong double digit. I'll leave it at that. Not specific, because it's really hard to call on a specific rate within the equities market, because a lot can happen between today and April, say, not even December. Our view might change altogether. But then, based on what you're seeing already, we are seeing a very strong, which is in line with our outlook last year and this year, and the markets have performed in line with our expectation, is that recoveries will be keen to really see mean reversion pulling up us back to where fair value estimates are around. And 3 factors are key. First has to be with what technicals are saying. And there are 2 kinds of investors from a technical perspective. There are those who count on momentum and those who count on mean reversion. Momentum investors say prices go and they keep going. Those are the like of Nvidia in the US saying you just keep on buying at whatever price, at 158, just buy. But then there are mean reversion who said when there is no more news, then prices will revert back to their mean pricing. And it's a theory that works not only in the markets but out of the markets, with the likes of Nicholas Taleb, the author of Black Swan Events, in one of his Enchato series, saying in life even a lucky idiot in the long run will revert back to his mean trait of being a less lucky idiot, and an unlucky wise will in the long run revert back to being a lucky one, because everyone reverts back to their characteristics. So pulling that in, shy of the banking sector, mean reversion suggests that there is a lot of headroom for stocks. Looking at the telecommunication sector, there's about a 50% discounting by the consensus view in the market. There's a long headroom for stocks to recover. But then there's a caveat to this. First, you might see small cap stock, as what is happening currently, really being on the front run of this bull market recovery, because for large cap stocks there is an aspect of sophisticated investors and heavy capital oriented investors driving the performance, and most of the time it has to be the foreign investors. But then with the Trump 2.0 policies and the ripple effects globally, there is a true chance that we might see flows remaining in developed markets longer than expected. So that might mean there will be recovery within the large cap stocks, but then it might not get to that point of full recovery. Secondly, the stock market is favored by having better visibility on international indices. I mean, we had more than 10 stocks being added on the MSCI. FTSE last year reviewed Kenya positively, and for an investor looking into the Kenya through an index, they have more propositions and more investment options. And going back to the quote, a rising tide should lift all boats. So that's key. And third, and most importantly, has to do with fundamentals. Within the sectors, looking at the key sectors, fundamentals remain largely strong. So Warren Buffett, going back to him, he's famous to say you better buy a fair company. You better buy a wonderful company at a fair price than a fair company at a wonderful price. So with fundamentals remaining strong, even once prices really revert back upwards, there's still room for more investment, because discounting and looking at the value to perpetuity, this company is expected to remain stable long term. So these 3 factors should play heavily in a strong double-digit performance for the BOWs in 2025.
All right, great. I think before we wind up, you mentioned something, as you're closing your point, small cap stocks in these, in terms of, and we know, again, like you mentioned, these are not sophisticated investors driving any of those prices. A lot of them is local and retail, individuals trading. So a lot of speculation. I don't know whether there are any observations you've made. There are people always wondering, without naming any stock here, what do you think about stock X? I've realized it's up 60%. And you only realize, it's quite a small cap. You're moving from 30 cents to 80 cents. So, a share that was in the cents now trading about a shilling and some cents on top of the shilling. And you always wonder, what observation do you make of small caps? Is it time maybe we also look at what potential small caps might represent for strategies, not just looking at, your usual blue chips, the mature, bigger companies at play. What have you made of the whole?
Well, broadly speaking, small cap stocks tend to be underrepresented from a research perspective, because research, what I've realized, it tends to follow, and this is a global thing, it tends to follow where capital is going. So the larger the market cap, the larger the trading volumes, the more research they are washed with. But then for small cap stock, there might be value that overall investors are not aware of because of that lack of depth of coverage. That's one. Secondly, for you to see that 60%, 10%, sometimes it has to do with volume weighted average price. For instance, a large cap might trade, say, 200 million worth of turnover in a day. That's several number of stocks. But then for a small cap, it might trade 5,000. Price it at about 50 shillings, that's 100 stocks moving. So that 100 stocks can move 10%. But then with this, the larger buck on you'd find when you volume weight it, there'll be those who traded at a higher price, medium price, closer to the price levels yesterday. So movement in large caps, unless it's founded on news, tends to be stable and more predictable. But then on small cap, just a few investors might decide, I want it at 10% up, and they move with the price. So volume weighted average pricing has a lot to do with what you're seeing. And again, most of them tend to be cheap. So for a retail investor wanting to invest a small amount of money, you'd find they'd prefer these small cap stock vis-a-vis large cap stocks, which sometimes may have already priced in a premium in some cases because of that wide and depth in terms of coverage and information flow and dissemination in the market.
All right. So for the friend who was asking me about StockX at 61% up, what should I tell them? Is it still something to consider, knowing what you just mentioned, the fundamentals around the small caps? Is it something to consider, or maybe you maintain a balance between what would be a prime stock and small cap? Should we join in the speculative wave or just sit off it?
Well, I believe speculate on fundamentally solid companies, which most of them tend to be within the large cap space. Hence that capital attention in the first place. So speculation is good, but it's dangerous to capital. And it's only when that tide of overall bullishness comes down, we'll see who's been swimming naked. Because you'd be left with, you locked in 60%, then you wanted another 60%. Then, it's no momentum. It reverts back at some point. Then you end up burning capital and the likes of stories that we're in the market. But then remaining on fundamentally solid companies, even when you don't recover on capitals, then dividend might be a saving grace in the long run. So speculate on fundamentally solid companies.
All right. Precisely. So that time appearance, we thank you again for being here. So that has been Wesley Manambo, Senior Research Associate at Standard Investment Bank. We've been talking earnings season and the expectations for stocks for 2025 at the NSE. And that has been another episode of Make Money, the podcast. And catch you next time.